Good morning and welcome to the ESKEN Limited full-year results investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions can be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during today's meeting. However, the company review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to David Shearer, Executive Chairman. Good morning, sir.
Good morning, everyone, and welcome to our full-year results presentation on a very sunny and the longest day, apparently. Hopefully that's not a reflection of the number of meetings we're doing with investors during the course of the day, but good to be connecting with you all. Lewis Girdwood isn't with us this morning. Lewis is currently on leave of absence for personal reasons. So I have been joined by Nick Dilworth, who's our Chief Operating Officer, and also the Executive Director for Renewables, and Nick will join me on the presentation here. A quick look at the agenda. I'm going to touch on highlights, go through the full year results, then we'll talk about renewables, aviation, and then I'll do a concluding slide. The first important point I want to address, however, is obviously the strategic review. When we last spoke to you in November, we said we had decided to undertake a strategic review. So this is the first opportunity I've really had to speak to you about the background to that, what our conclusions have been from the work we've done, and where we are in terms of current progress. Clearly, the group, when it entered the pandemic, had a historically high level of debt, which was due to the transactions it had done previously. And then, of course, the impact of the pandemic on us being in the aviation business and generally, and the backdrop, the economic backdrop which has ensued from that, has meant that we have been quite constrained in terms of our access to growth capital. So the high debt levels, when you look at them, have included, for example, financing 134 million of historic liabilities relating to aircraft leases. These are the liabilities which we had to take on in order to preserve the group at the start of the pandemic. But I'd put that there simply because it does show the extent of funding which we've had to address over the last 3 years. And as a result of that, we haven't been in a position really to invest and fully support the core operating businesses, which have different strategic and financial needs. So we decided to have a look at our strategy. And I'd always said I would look at the intrinsic value of the component parts of the business. And in any situation where the market, as these businesses recover, where the market didn't recognize the value and have that reflected in the share price for shareholders, then we would look to do something structurally. And that's what we have concluded. And we have set out that the interests of stakeholders are going to be best served by us seeking new owners for these two operating businesses through a managed sale process. And each of those businesses will benefit from having long-term strategic partners who've got access to capital and can support the growth ambitions, but more importantly, offering stability and certainty to staff, customers, and suppliers. So we use the sale proceeds alongside the continuing sale proceeds coming through from non-core assets to pay down our debt and unwind the group and ultimately return value to shareholders. So let me just update you on where we are on current progress. In terms of renewables, we have done a very comprehensive sale process. We've been working on that for several months. And we've announced this morning that we are now in the advanced stages of negotiation with a preferred bidder. And we'll update the market further on that as that comes to a conclusion. We've also started the sale process for London Southend Airport, and we're doing that against a backdrop of a positive aviation market, strong capacity coming back into London airspace, and people are back flying. So I'll touch on that later on in the presentation here. We chose to sell our star handling operations at Manchester and Stansted. I mean, essentially, that was a good business. The team had done well in terms of winning work at both these stations, winning contracts and demonstrating their ability to deliver them. But that was always a subscale business in a market sector that's dominated by the big players, the Swiss ports, the Minges, the DNATA. And we took the opportunity to sell that business on to someone looking for market entry at what we think was good value. And we're also progressing our plans to dispose of the remaining portfolio of non-core assets. And you would have seen yesterday morning that we put out an RNS that we had sold our investment in the plant, the Mersey biomass plant, which we also supply through the renewables business, but we sold that for 9 million. And that was an asset which at the prior year end, 2 years ago, had actually been written down to zero. So that is good news, and we would expect that transaction will conclude over the next month or two. So that covers a sort of update where we are on strategic review. Obviously, I can take questions on that when we get through the presentation. Just taking a sort of high-level business highlights. So in terms of delivering operational progress, ESKEN Renewables, it's had its challenges this year, as many businesses have had, with strong inflationary pressures, and we've also had some outages at the plants, but the management team there have taken steps to optimize the margins and looking at ways to augment supply agreements, and Nick will talk further about that when it comes to him. In January, we signed a multi-year agreement for the return of flying to LSA with EasyJet. They've got 3 summer routes to Malaga, Palma, and Faro. They have stepped up the frequency on Faro recently, and that's going well. And since the year end, we have now announced all-round routes, with Amsterdam having started already, all year-round routes, and Paris starting in October. So for the first time since the pandemic, the airport will be open all year round, and there are opportunities for more flights to come in there. We've always, over the last 2 to 3 years, looked to maintain strict financial discipline. And in November, we secured a new lending facility comprising 50 million of committed funding from a specialty lender to support us over the period of time, and that allows us to execute on the strategy and deliver on it. As at 28th February, we'd cash headroom of 50.3 million, and we've been continuing to reduce the cost base of the group in line with the reduction in the assets and the requirements of the remaining business, and we'll continue to do that. Just touching on residual matters, at the year end, 4 of the Proprius aircraft had been returned, with 4 aircraft remaining. But since the year end, we have now returned 2 further aircraft. We have 2 remaining, which will go back over the next few months. And all of these have been the maintenance updates, and the lease payments have all been returned in line with the costs we expected and which were fully provided in prior years. So no surprises there. Legacy tax issues over the last 2 to 3 years. We changed tax advisors, and under Lewis, focus on a number of long-standing tax cases, which we have largely resolved. There is now 1 left outstanding, which has a remaining provision in the accounts of £1 million to settle. And that allowed us to release 2.3 million of tax provisions this year. Finally, on legacy legal matters, these are now largely resolved, and we do have some cost recoveries, which will come back to us in the course of the current year. So let me move on to financial performance. Financial summary, high level, revenue 120 million. Revenue improved in the renewables business quite strongly, but that was at a lower margin than Nick, as I say, will talk to that shortly. Adjusted EBITDA reduced from last year, but that was largely that last year benefited from some one-off income that had been received. And in overall terms, the loss before tax reduced due largely to favourable impairment improvements. I won't touch on the net debt here. I'll pick that up shortly in the debt slide, and I've already referred to the headroom being 50.3 million at the end of the year. Picking up on the renewables performance here, you'll see the tonnages at renewables were up Aviation passengers came down a bit from last year, primarily due to continued disruption with staffing last summer in the airline industry. It does seem to be better this year in terms of disruption, and we wouldn't expect to see that repeat. And we've had some good benefit at the airport with jet center operations for the private jet market, and the hotel has been doing well. Group central revenue reduced as a result of some rental income, which we were previously receiving, but these assets were sold last year. Moving down to the adjusted EBITDA numbers, renewables impacted by the unplanned outages, and that resulted in a change in the margin mix on the plants. Nick will cover that shortly. And in the year, aviation received 1.4 million, which was a recovery against previously committed airline marketing support payments, which it got back when the airline pulled out from the airport. But in the prior year, we had benefited from some one-offs through the conclusion of the Connect Airways and the partnership at Teesside Airport. So that explains that difference there. And looking at investment and non-strategic infrastructure, last year was an unusual year because it had a 4.7 million one-off property provision reassessment on a property that we had exited and got out of. In Group Central, you'll see the movement down in costs there. There is still more we are doing on that, but the largest part of that reduction was a significant reduction in the legal fees, as I just mentioned a short while back, having largely concluded the legacy legal issues that we had to address. The next slide just shows us in a bridge in a tabular form. I won't dwell on it too much, but from this you can see that renewables down 1.9 million, aviation only down 0.9 after you adjust for the one-offs, and you see the benefit of the group centrals there. How does that translate into loss for the year? Obviously, we have depreciations and impairments. If you look at the net finance costs, including Forex, the 6.2 at the top is interest we pay on the exchangeable bond, debt issuance costs, and interest that we pay on finance leases. And the 14.5, which is non-cash, is largely about 13 million of that is a roll-up of interest on the convertible loan note in LSA with Carlisle, where that interest is picked. The 7.3 million reversal of impairment of loan notes, that relates to the Merseyside biomass plant, which I mentioned. We had previously impaired that, and that was then released in the balance sheet date because we were in the course of negotiating a transaction which clearly showed that we no longer needed that impairment, and we are now, that is a deal that's been done at 9 million. And then just touching on the tax improvement there, that is the release of tax provisions and small tax credits. So nothing further really to cover on that slide. Looking at cash, we got the proceeds from the new borrowings in November. That was 50, less costs of issuance and less amortization. And the other main item there is the repayment of debt, including interest, which was our clearance of the old bank debt, etc. And you can see from this cash used in operations, absorbed in operations at 9.4. Discontinued is appropriate at 24.8, and that brings you down to our cash balance at the end of the year, which is broadly in line with what it was at 28th February 22. Moving on to the balance sheet, the intangible assets figure there is goodwill, largely on the renewables business. So as renewables goes, that will move out. The investment non-current receivables is the effectively the 10 million of shares we hold in LDG against the exchangeable bond, and there's £5 million in the captive insurance company there, and some other minor items. In terms of the detail of the loans and lease liabilities, I'm going to cover that in the next slide. So this shows the net debt movement, the amount of net interest paid and accrued interest, cash used in operations, purchase of PPE, proceeds from the sale of properties, etc. And that brings out the total debt figure at the end of the year. But I think the next slide is the one which is of more interest, because that actually shows where our liabilities are in terms of timeline. So taking it from the top there, other lease liabilities, that's the old style, as I call them, hire purchase and asset finance. And we've broken this out to give you an indication of where it sits. So 13.2 of that sits in renewables, and we'd obviously go with renewables when that's sold. And there's 3 million of that in aviation. The next box is obviously IFRS 16 lease liabilities, which are the old operating leases. And again, I've split this out showing where that would go. So renewables would take its operating leases with it, 27.3. Aviation would go ultimately when I sell the airport. And the other is a mixture of offices we've got, and also some distribution centres where we sublease those to the former Eddie Stobart on a back-to-back basis. So there is actually income coming in against that, and there is a right-of-use asset held against it. The 15 million of liabilities, IFRS lease liabilities for Proprius, are those remaining at the 28th of February. That number will have reduced as we continue to pay leases, and should run off by the last quarter of the year, finally. The exchangeable bond, it is due to be repaid in May 24. 52.6 million, but there's circa 10 million of shares in LDG set against that. These can be put to the bondholders, and we would simply then refinance the remainder of the exchangeable bond. Finally, the balance on the net debt facility, that runs through with a maturity date of December 25, but clearly on the basis that we sell renewables, as we've announced this morning, that would be cleared ahead of that, and that number will no longer sit there. And the final part is the convertible loan with Carlyle. That goes out to maturity date of August 28th, and again attaches solely to LSA on the basis that as and when we sell the airport, that debt would be redeemed, and then we have the net cash there. So I'm now going to touch on the operating performance, and first up I'm going to hand over to Nick, who's going to cover a short bit on ESG and then on renewables. So Nick.
Thank you, David. Good morning, everyone. Before looking at the specific divisional performance, let's briefly touch on our progress with ESG throughout the year. We've continued to build positively on our journey over the last 2 years, and irrespective of ESKEN's process to sell its core assets, as outlined by David, our operating divisions recognise the importance of developing plans to continue to reduce our carbon footprint. Across our businesses, ESKEN has realised a reduction in carbon dioxide emissions by 11% during the year on Scope 1 and 2 compared to our baseline year. In addition, we developed a net zero roadmap to eliminate Scope 2 emissions by 2030, which is also aligned to the growth plans of our core operating divisions. Our teams have built positive relationships with our charitable partners during the year, and we've also engaged in over 500 hours of volunteering to benefit the communities in which we serve. It's also been an invaluable opportunity for our teams to do team building exercises, which in a post-pandemic period has been invaluable. During the year, we also established an ESG risk register and put in place performance KPIs linked to executive remuneration. Finally, in recognition that the operating businesses are to be sold from the group, we've put additional focus on ensuring the governance structures within the individual businesses are appropriate to take forward the ESG culture and build upon the good work to date. If I now look at the specifics of ESKEN Renewables before passing back to David on aviation, we'll look at the progress during the year. During the year, ESKEN Renewables took steps to optimise margins and secure additional sub-supply agreements. ESKEN Renewables supplied approximately 1.6 million tonnes of biomass fuel, which was up 9.4% on the previous year, resulting in a 17.7% increase in revenue to 93.7 million. As outlined by David a short while ago, the additional volume was largely lower margin attributable to forestry byproducts, which when combined with the unplanned outages at plants where we supply higher margin wastewood and the impacts of inflation, resulted in a 9.5% reduction in EBITDA to 18.4 million. Looking forwards, the contracted RPI indexation provisions within our long-term contracts means the inflationary impact incurred during the year will be mitigated in FY24 and therefore can largely be seen as a timing difference. Together with tight cost control and our plan to optimise fleet size, this bodes well for the future. The closure during the year of the loss-making Port Clarence processing and storage site will also improve EBITDA on a recurring basis by 0.9 million per annum, and that's with effect from the 1st of April 2023. FY24 onwards will also benefit from the full year effect of those new sub-supply agreements. Appreciate there's quite a bit going on this slide. If we focus on the left-hand side, we split out the volume of contracted supply, which is up 9.4% during the year. And as touched on a moment ago, that's largely driven on the bottom box with an increase in lower margin forestry byproducts. If you look at the top right-hand side of the slide, we can see the impact of the unforeseen plant outages on the volume of wastewood supplied to plants compared to the previous year. Overall, this led to a reduction year on year of 6.9%. Together with a more competitive market for waste wood, this in turn impacted gate fee income, which is the income that ESKEN Renewables takes from its supply base on the receipt of waste wood. The effect on the gate fee performance can be seen on the bottom right-hand side of the page. The impact of the unplanned outages and gate fees in turn was exacerbated when we look at when the unplanned outages occurred, which were during the summer months. The summer months tends to be the period when gate fees are at its highest given the seasonality in the wastewood market. I shall now pass on to David to pick up the relevant points during the year for aviation.
Thanks, Nick. Well, clearly I'm covering aviation in Lewis's absence. He would normally talk to this. One of the key things that was done through the year in aviation was we had a fundamental change out of the senior management team at London Southend Airport. So we've brought in from external a new chief executive, a new CFO, and a new business development director. And we promoted internally at an operations director and a commercial director. And that new team have been energized and have looked at the airport very much as almost as a startup airport again. And they've had the benefit of aviation starting to recover and against a very strong backdrop in the London aviation market. So in January 23, as I said earlier, we signed a multi-year partnership agreement with EasyJet. That is working well. It is working well both for EasyJet and ourselves. And we are getting good traction on these routes. As I said, previously, staffing challenges and industrial action at airports last summer did have a bit of an impact on inbound flights, but we don't see that repeating this year. And in May 23, EasyJet started a new all-year round route from LSA to Amsterdam. That was one of the strongest routes we had in the pre-COVID period, so it's good to see that is back with us. And they also stepped up by putting on an additional 4 times a week flights to Faro, which is a reflection of the demand that is existing there. And we've recently just announced, as I said earlier, an additional flights to Paris Charles de Gaulle starting on 29th October. And the key thing being that we will now be open all year round for the first time since the pandemic. We'll have flights to Amsterdam and Paris, and we are still in discussions with other airlines and other operators about additional routes. So I think it's fair to say LSA has got a very strong proposition to address the London peak time capacity constraints. Think of it as an overspill, as they used to say before pandemic. But we proved before the pandemic that it does actually work. We have a very strong proposition. And the evidence in the last week or two that peak time capacity at London airports is now beyond where it was in 2019 means that the traction that we're seeing in terms of demand and passengers wanting to fly can only benefit us going forward and as we look into next year. So I'll come on to the discussion on selling the airport on the next slide, but that gives us a strong backdrop to where our starting point is on this. And I said already that we took the opportunity to sell our subscale ground handling operations at Manchester and Stansted, but we have retained the capability at London Southend Airport so that we can focus on supporting the needs of our airline clients there. The next slide is, I think, a very important one because it's the key to where we see value at LSA. And I'm actually using this also in our information that we're putting out to prospective buyers. So we are ideally placed. We are the only overspill airport with capacity in the London airspace markets. Now we can take planes immediately. We are back to full operational capability. We're well connected, as we said before, with the train journey into central London. And of course, with the Elizabeth line having now fully opened, either jumping off at Stratford or Shenfield, you've got connectivity right through to the west of London. We're increasingly serving an affluent catchment area, and that catchment area increases with the ability of the Liverpool line coming, the Elizabeth line coming through. And we have a strong diversified revenue generation across our purpose-built infrastructure, which, as you might recall, prior to COVID, we were expecting to have circa 2.5 million passengers through with our existing footprint. And it's only once we go beyond that and approach 3 million passengers that we actually have to incur any significant capex to allow us to scale up to 5 million and beyond. We still remain London's quickest and easiest award-winning passenger experience, train to gate. And we do see the opportunity for there to be an accelerated upside to our working case assumptions. Our momentum is definitely building. So we're on track to accelerate our recovery beyond pre-COVID levels. And in order to do that, as I said, we don't need to incur significant capex until we get towards 3 million passengers. And even then, the actual capex numbers we're talking about compared to what would need to be spent at other airports, even if they had the peak slot capacity, still makes us a very compelling argument. There's obviously in the press over the last couple of weeks been a lot, the Paris Air Show has been on just now. There's been a lot of talk about aircraft demand, and Boeing and BAE are fully, and Airbus, sorry, are fully, I think they've got full order books for the next 10 years. And we saw a few weeks back that Ryanair had announced the order of 300 Airbus 737 MAX 10s. Wizz have got some big orders out there. Some of these planes are obviously replacement for older kit, but quite a large number of them are to increase capacity and see the growth in capacity. And essentially, those that come to the UK and want to be in London will have to base themselves somewhere, and the only effective place, we believe, is London Southend. So that underpins the discussions which we're having with the airlines at present. So we have started the process just in the past couple of weeks. We've been focusing on the renewable sale, obviously, to get that to the point where we are. But we have now started the process of reaching out and talking to prospective buyers in London Southend. And we intend to move that quickly, consistent with achieving value for shareholders. And we do believe that the right strategic buyers will see the opportunity and will move quickly to engage with us as we go forward. So the key slide in winding up is really unlocking shareholder value. That is what our priority is. Renewables, we're looking to move that disposal process ahead. That's our clear priority, is to close that deal, get it out to the market, and get the debt repaid on the funds in. And then we'll shift the focus and crank up on London Southend Airport. But meantime, with LSA, the partnership with EasyJet is going very well, and our management team there are proactively talking to new airlines. We're continuing with the sale of our other assets, and we've got the 9 million MBE. The two main assets we then have left are the Port of Weston at Runcorn and Carlisle Lake District Airport, and we are progressing discussions on both of these and looking at the opportunity to crystallise value near term on them. And against that whole backdrop, we are looking to continue to reduce central costs in line with shrinking the group right down, because there's no point in generating value from asset sales and still having a cost base at the centre which is too high. At the end of the day, that is shareholders' money, so we will be constraining that very tightly to put us in a position where we can then return value to shareholders. So I'll now hand you back to our moderator, and who'll just remind you of the way in which you can ask questions. Thank you for listening, and I look forward to taking your questions.
David, Nick, thank you very much indeed for the presentation. As David said, ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you that recording the presentation along with a copy of the slides and the published Q&A can be accessed via your investor dashboard. David, as you can see, we have got a number of questions have come throughout today's presentation. Thank you to everyone for submitting those. Could I just please ask you to read out the question and give a response where appropriate to do so, and I'll pick up from you at the end, please. Thank you.
Sure. Let me just start at the top. I've got questions from Stephen. What conditions are needed for LSA to get back to pre-pandemic volumes? I think, as I've said, the basic infrastructure is available to us to get us back to pre-pandemic volumes, and we only need to incur any more capex beyond that. We do believe, in terms of the macro, that people are returning to flying very positively. Anyone who's gone through any London airport recently will know that they feel crammed. There's a challenge on the schedules flying in and out of these airports. It's leading to delays. If there's a bit of bad weather, which we used to have 30 years ago, but the schedules allowed them to cope with that. It just seems to knock the schedule for 6. So I think the conditions are there. I think the passengers recognise the opportunity at London Southend. I think EasyJet have been very pleased with the response they've had to their flights, as evidenced by them putting more availability onto Faro. I think the one constraint many of the airlines have had this year is just the availability of planes. I think they may have been slightly surprised as to how quickly demand came back, but that's starting to work its way through the system now, and planes are becoming available and coming on stream. So the backdrop, I think, is essentially there to allow us to get back to pre-pandemic volumes and work well to that. Gerald has asked, how long does the exclusivity Period with the renewables preferred bidder last. How do you mitigate the risk the prospective buyer drags out the process? I think on that one, what I would say is we ran a very thorough process, and it was an auction, and we did have other bidders, and we chose the bidder we're working with on the basis that we thought they had the right terms and the right deal and could complete within the timescale we wanted to. The reason you have an exclusivity period with an end date is that it's as much our power to keep the bidder honest and allow them to get there by that date. We were quite clear to all the remaining bidders when we said, put your final bids on the table. We need the deadline for when we want to have the deal signed. The exclusivity period coincides with that. I'm not going to give a specific date at present, but it is, as is normal with these things, something that you check in on a regular basis with your bidder as it's progressing, and you make sure you're still working to that date. And there is nothing this far which has changed our view as to both the terms of the deal or the timing of the deal compared to what we expect to have. Mark M, have you agreed a provisional price for the renewables? Well, as I've just said there, it was actually an auction process, so people had to put their best price on the table. That is the price we're working to. That is what's in the deal, but it's not something we're disclosing at this stage for obvious reasons. Mark then asks, is the airport part of the 43 million non-core assets? No, it's not. I think it's probably in the other investments line as a fairly small balance, but the carrying value of that, Mark, is quite low. Fiona H, what is the lifetime liabilities relating to Proprius? The 134 million I referenced in my first slide was what the total cost would be of through to the conclusion of that. But as these liabilities run off and we return the planes, that's when the liabilities terminate and finish. There is no tail liability beyond that. As I said, we're down to the last 2 planes, which are in maintenance and refurb because you need to get them up to handback conditions. These are already identified as to where they're going by the lessor. And once these planes are handed back, we are done. There are no further liabilities will rest with the business beyond that. What is the projected financial, Fiona also asking us, what is the projected financial position of ESKEN post-sale of the operating businesses? We're not in a position to disclose that at present, but clearly the whole intent of this exercise is to sell our key operating businesses for value to allow us to clear all the debt in the business, and the residual value, which is then left, would be returned to shareholders. And I've probably answered the next question, which you also asked Fiona about, will it crystallize a positive return for distribution to the shareholders? Clearly, that is very much dependent on market conditions and what price we get for the business, but we believe it's the right answer, and we are performing our duties to shareholders. Rob, when renewables are sold, do you envision the group will remain listed? I think the intent at present is that the group will continue to remain listed. Interesting enough, when we got ourselves to a clean position, we would be one of only, I think, 7 listed airport owning businesses in the world. So depending where we were on our sale process of the airport at that time, that could be an attractive investment opportunity for people who may see the opportunity just to come in and take the whole thing. But the intent is at present that we would retain the listing through to the conclusion of the full sale process, and would then return value to shareholders. You probably see in the RNS that we've said we intend to put a proposal to shareholders to step down from premium listing to standard listing. That is purely a reflection of the size the business will be at that point, and also it reduces some of the admin cost burden that are on you when you're a premium listed business. And then I've got Damien, please can you elaborate more on the next steps of renewables sales process and key remaining hurdles? The key thing is, at the end of the day, you know, we're in a preferred bidder stage. That means that they've had a lot of information. There has been a lot of diligence done, and we'll update the market as that process progresses and as we close out that deal. Does the sale process for LSA and the fact there will be a new owner impact discussions with airlines on taking slots? This is from Alex L. In reality, Alex, we're very cognizant of the need for airlines to have a view on a stable platform and a robust owner for the airport. The airlines are aware of what that we are talking to, are aware of what we're doing there, and are aware that it is our intent to get a long-term strategic partner for the airport who actually has the capability we don't have, for the reasons of our previous financial constraints, to invest in behind the airport. And actually, in many respects, a sale of the airport to the right partner is likely to be a win-win for the airlines and may lead to a better outcome for them. And I'm just going down the questions. Well, Alex, you've asked our advisors hired in the sale of LSA. Yes, we've been working with advisors since the start of the strategic review process, and we do have advisors in place. And final one from Alex: how's the busy summer season shaping up for renewables in terms of gate fees? I think they touched on that and said, you know, the gate fee environment is improving as we move into the summer period, and that's very much in line with what we have tended to see before. There's one question here from Fiona, which said, where does 30% shareholder Carlisle stand on the aviation disposal? Just to remind you, at this stage, Carlisle are purely a debt holder into London Southend Airport. They have a conversion option attaching to it, which they can convert into 30% equity only in the airport. But clearly, if they decide and choose, they are a potential buyer for the airport as well. But we will be going through a proper process, and they can participate in that process. So I'll just give you an opportunity in case there's any other questions. Questions come up. Oh, there's one just come up. What is my view of the current share price, currently around 2.7p? Well, Mark, actually, you've given me news that I don't have access to on my screen there. I always adhere to an old piece of advice I got from an old broker many years ago when I was relatively young into the business. And when you have a volatile share price in odd markets, the broker basically said at the end of the day, don't look at the share price every hour or every day. Just keep your head down, deliver what you say you're going to deliver on the business, communicate properly to the market, and let the market form its view on your value. And I still apply that piece of advice. I say that to my team here, because obviously it's dispiriting when they see a very low share price. But, you know, we're not alone in that. Small and mid-cap markets, UK markets at present, are out of favour with investors. But, you know, we'll just stick to what we said we're going to do here, and we'll hopefully deliver the true value for shareholders that we believe is in these core businesses.
David, thank you very much indeed for addressing all those questions from investors. And of course, you will be able to review any further questions that are submitted today, and we'll publish those responses where appropriate to do so on the Investor Meet Company platform. David, perhaps just before redirecting investors to provide you with their feedback, which is particularly important to you and the team, just a few closing comments, if I may. Yeah,
sure. I mean, we've got that last slide sitting up there. It's all about unlocking shareholder value. You know, my team and my board's key priority is going to be, let's get the renewables transaction closed out and deal done that's right for that business. It'll be right for us. Excuse me. And let's continue to support London Southend Airport against the backdrop of a very positive aviation market. Let's see some more traction coming into that airport as we're engaging with prospective buyers. And let's find the right owner for that airport who actually sees through the short-term issues which there have been through the pandemic and sees the real value of owning a strategic London airport asset. And while we're doing these two things, we will continue to manage the rest of the business and unwind unnecessary costs and tidy up residual assets. And hopefully when I'm back talking to you based on our half year, we'll be able to update you further on significant progress. So thanks for your continuing support, and I look forward to engaging with you in the weeks and months ahead. Thank you.
David, Nick, thank you for updating investors today. Can I please ask investors not to close the session? It should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of ESKEN Limited, I'd like to thank you for attending today's presentation, and good morning to you all.